In the previous video, we looked at Ethereum on the 15-minute chart. At that time, the market was still indecisive. Buyer had shown potential. Seller had not produced the lower low needed to decisively invalidate the bullish idea. But there was also no strong bullish impulse yet. So the market was still developing. And I asked one simple question. What is Ethereum actually building? Well, now we have an interesting development. Ethereum started moving strongly bullish, and the market has now moved approximately 2 times the range of the bullish candle that formed the bullish engulfing pattern. But this is where the story becomes interesting, because what if you were already in that buy? What if you entered when the bullish reversal appeared? What if you saw the broken support being recovered? But then you got tired of waiting. You closed your position and walked away, only to see Ethereum move strongly in the direction you originally expected. What would you think? Because this is something that happens to many traders, and it raises a very important question. What if you were actually right about Ethereum, but you still gave up? And remember, the example we're looking at here is based on the 15-minute chart. But the principle we are discussing is not limited to the 15-minute time frame. Because the market is fractal, the same structural behavior can appear across different time frames. The scale may change, the size of the movement may change, the duration may change, but the underlying structural relationships can repeat. So whether you're looking at a lower time frame or a higher time frame, the same way of thinking can still be applied. You are not simply looking at a 15-minute pattern. You are learning to recognize how fractal structure develops, and that is important. Because once you understand the structure, you can begin to apply the same thinking across different time frames. Now, what if I told you you were actually right about Ethereum? You saw the bullish reversal. You saw price recover the broken support. You entered a buy. And then nothing happened. Ethereum didn't move strongly upward. Instead, price moved sideways, up, then down, up again, then down again. Candlestick after candlestick. The market seemed to be going nowhere, and eventually you got tired. You started questioning your decision. Maybe you thought, I entered too early. Maybe this bullish reversal isn't working. Maybe Ethereum is going back down. So you gave up. You closed your buy position and you walked away. At that moment, you probably felt relieved. The emotional pressure was gone. You no longer had to watch the chart. But then something happened. Something you didn't expect. The market started moving strongly, and it moved in the direction you originally expected. Ethereum started going higher, and now Ethereum has moved approximately 2 times the range of the bullish candle that formed the bullish engulfing pattern. And suddenly, you realize something painful. You were right, but you still lost. Not because the market proved your original analysis wrong, not because your bullish idea was necessarily invalidated, but because you gave up before the market finished revealing the structure. And this is where the pain becomes real, because now you are no longer inside the trade. You are outside the market, watching the position you once owned move exactly in the direction you expected. You look at the chart. You remember the moment you entered. You remember why you believed in the bullish idea. You remember the bullish reversal. You remember the broken support being recovered. And you remember you were the one who closed the position. Now the market is moving higher, but you are no longer participating. The worst part is, you may start thinking, I knew it. I was right. Why did I close the trade? And then you may feel the urge to enter again. But now, the price is already much higher than where you originally entered. The risk is different. The structure has already changed. The opportunity you originally had may no longer be the same opportunity. And this creates another painful situation. You were right about the direction, but you missed the move. You had the position, but you couldn't stay with it. You understood the opportunity, but you didn't understand what the market was doing while you were waiting. And this is where many traders experience the most frustrating kind of loss. Not the loss caused by a stop loss, but the loss of an opportunity that they already had in their hands. Think about that for a moment. You entered because you believed buyer might be taking control. The bullish reversal pattern was there. The broken support had been recovered, and the market had not yet produced the lower low that would decisively invalidate the bullish idea. But seller also wasn't able to produce the lower low you were watching for. And that was information. The market was telling you something. Seller was trying to continue the bearish movement, but seller failed. And while you were looking at the chart thinking nothing is happening, the structure was actually developing. The market was testing both sides. Buyer had not yet fully proven their authority. Seller had not yet completely disappeared. The market was indecisive. But indecision is not the same as invalidation. This is where understanding fractal structure becomes important. Because if you understand the structure, you don't simply ask, is price moving in my direction? You ask, has my idea actually been invalidated? Those are two completely different questions. A trader who doesn't understand structure may see price moving sideways and think, my trade isn't working. A trader who understands structure may see the same price movement and think, the market is still developing. The difference is not necessarily the entry. The difference is what they understand while they are waiting. And this is where many traders lose. They don't always lose because their analysis was wrong. Sometimes they lose because they couldn't tolerate the uncertainty between the moment they entered and the moment the market finally revealed its intention. They were right about the potential direction, but they were wrong about one thing. They expected the market to prove them right immediately, and the market doesn't work that way. Sometimes before buyer produces a strong bullish impulse, the market needs to move sideways. Sometimes before seller completely loses control, seller needs to fail. Sometimes the most important information is not a higher high. It is the fact that seller failed to produce a lower low. And when you understand that, you begin to see the market differently. You stop treating every sideways movement as a reason to exit. You stop assuming that every delay means your analysis is wrong. And you begin to understand that the market is constantly communicating through structure. Now look at what happened to Ethereum. The trader entered the buy. The market became indecisive. The trader became impatient. The trader closed the position. And then the market moved strongly bullish. And now, Ethereum has already traveled approximately 2 times the range of the bullish candle that formed the bullish engulfing pattern. So ask yourself, was the trader wrong about Ethereum? Or did the trader simply leave before the market finished telling the story? Because sometimes the difference between a profitable trade and a losing trade is not whether you predicted the direction correctly. It is whether you understood the structure well enough to know when your idea was actually invalidated. And this is one of the biggest differences between simply watching price and understanding what price movement actually means. The trader who doesn't understand the structure sees uncertainty. The trader who understands the structure sees information. And maybe that is the real lesson from Ethereum. You can be right about the direction and still lose. You can have the right entry and still exit too early. You can correctly identify a potential change in authority and still miss the move, because being right is not enough. You need to understand what the market is building while you wait. And this is exactly why fractal authority model is not about predicting every move. It's about understanding the structure, recognizing the levels that matter, understanding when authority is still developing, and knowing the difference between indecision and invalidation. Because if you understand that difference, you may stop giving up just before the market proves that you were right all along. Subscribe to Bias Positive Digital Rise on YouTube. Let's build a community of traders who don't just watch price move, but learn to understand what the movement actually means. And I want to hear from you. Have you ever closed a trade because you thought your analysis was wrong, only to see the market move exactly in the direction you expected after you exited? Tell me your experience in the comments. Let's discuss it. Let's learn from each other. And let's build this community together.